What financial statements does my business need? I talk about this every day, all the time, and so it becomes a bit of a broken record for me. But basically, there's two types of financial statements that you, as a business owner, definitely need to know about. You have a balance sheet and you have an income statement. An income statement is also referred to as a profit and loss statement. And they're not the same. Most business owners just assume when they hear financial statements that it's a kind of a catch-all phrase, but the reality is there are lots of things that go into financial statements, but basically for purposes of borrowing money, there's two distinct statements you want to take a look at. One is a balance sheet, the other one is your income statement. Your balance sheet says what do you own, what do you owe. Your income statement says what do you earn and what do you spend. And those two statements work together to determine how well your business is doing. In my experience, businesses use their income statement all the time. You can talk to any business owner and they'll say, oh, our revenue this year is going to be $1 million or $5 million. And if you press them, you might be able to get them to tell you what the net income is going to be. So after we pay all of our expenses, we're going to have $500,000 this year, or $250,000, or $5 million. But then if you ask them what the implication is to their balance sheet, how much debt did you pay off, or how did the money move through your business? How do you know you're in a better position this year than last year? Most business owners will say, well, we did $5 million in business. It was a great year. But when you don't understand how the financial statements work together, you can often find yourself in a position of saying, I don't understand how we make so much money and yet we have nothing left over. And so I would encourage business owners to take a look at their balance sheet. After you've earned your money and you've spent it on expenses and there's some left, then you need to understand, okay, so what was the impact to what we own and what we owe? And are we in a better position this year than we were last year? One of the very quick things you can do, if you have your financial statements available, or if not, you can pause this episode, go get them and bring them back. But on your balance sheet, there should be a line item near the bottom that says retained earnings. That's a pretty important line item that helps link the two statements together. And your retained earnings basically tell somebody like me or a bank or even you what the cumulative effect of all the money you made and all the money you spent was. So if that number is positive, chances are you've got a healthy business. If the number is negative, then it means that your business simply doesn't have the cash it needs to meet its obligations. I'm oversimplifying it, but the point is that if you're a business owner that looks at their profit and loss statement, what did we earn, what did we spend, what's left, that you should also spend some time looking at your balance sheet. What do you own, what do you owe, and what's left? Banks want to know, most importantly, how cash is used in your business. And so when they look at your financial statements, they're looking not just for revenue and expenses. They're really concerned with, over the period of the loan that we're giving you, so if it was 5 years or 7 years, how does our loan balance shrink? How does the equity in your business grow? And if you added our money to your business, is it actually helping your business achieve something, or is it just glossing over problems that your business has that you need to spend some time fixing? Your accountant should be able to help you identify the areas in either your income statement or probably more in your balance sheet that need to be improved. So the classic place that I start when I look at a balance sheet, of course, look at retained earnings. The very next thing I look at is accounts receivable and accounts payable. If your receivables in your business, you're expecting payment from customers, and let's say it's $200,000, but your payables, the bills that have to be paid by the business, are $300,000, well, you've got a $100,000 shortfall, and that's a problem. So that's an example of something that your accountant, either your in-house accounting team or your accountant who does your year-end statements for you, should be able to sit down and identify on your balance sheet. They should walk you through your financial statements and show you the areas that you need improvement. If you're looking for a business loan, then it's really important that you understand what your financial statements have to say. And of course, you can use mlenow.ca to get a very quick idea of what that needs to look like. So if you punch in a loan amount, it's going to tell you how much equity your business needs, how much net income it needs. But even without mlenow.ca, you yourself, if you're going to go and talk to a bank, you should know what they're looking for, and you should make sure that your financial statements reflect what the bank is going to want to see. And there's lots of help out there available. There's lots of websites, there's lots of tutorials, but the best person to talk to is your accountant, and they should be able to help you with that.